Hello everybody. Do you want to make 100% of your portfolio on Brent? Okay, let's us discuss this analysis and make a decision together. Brent oil has been an index since 1980s for many crude oil around the world. It came from the oil field called Brent in UK, and it has own API specification. Nowadays, we have Marban listed in Abu Dhabi Stock Exchange, and it comes from the oil field onshore in UAE called Marban field. Marban products specification is almost like Brent. It launched in March 2021 in Abu Dhabi Stock Exchange. It is for future contracts. Priced initially for 63.3 roughly for last month. Now, if we want to analyze the Brent prices throughout the last 2 years. We see Brent varies from 65 to 18, and WIT in America from 40 to minus, and it became minus. That's mainly momentarily due to the lack of storages when there was a sharp drop in the demand of oil. As we said, Marban field has 10 billion recoverable oil, backed up by ADNOC. And ADNOC is the national company for UAE, and UAE considered to be the third biggest producer for oil in the world. The production is around 3.5. If we compare the differences in prices between WIT and Brent, we can see throughout the years from 10 to 5 or $6 differences. That means if Brent is trading on 61, WIT will be trading in 57, something like that, plus or minus. Does Marban index will act the same against the Brent? I have doubt that there will be big differences in prices because the specification is of API is almost the same. So now, and if we look to the last 2 years, the reasons for letting the Brent price to go to 18, we can classify them into two. One political, and one is demand versus supply. Political reasons were adopted at that time to gain some political gains against Russia from American, because Russians are selling their oil and gas cheaply, and the oil was selling. They were selling it for $35 to Europe. The political reason was very clear to everybody who analyzed the market, and we noticed that in many or several OPEC ministers' statement to the media. So it was very clear for us that was it. Unfortunately, during that time when the oil price around 65 heading to 40 and below, the COVID-19 pandemic came to surface, accelerated very sharply down to the 18, in America to the minus. Now, that reason that led the Brent to go down is out of everybody's hand. but reflected on the demand versus the supply. So OPEC went and then decided to cut the production by 15 million barrel per day. Okay, this political reason no more valid at this time. So we will concentrate on supply and demand. The supply and demand can be affected from two ways: from OPEC's production, and from outside OPEC production, and from the other source of energy on the market. Other source of energy in the market from alternative energy, solar, wind, battery storage, hydro, nuclear, and so forth, and conventional energy from the gas. If we look to the other side, OPEC can supply the 15 million oil immediately, because they have the facility and they have the capability to supply to the market. Now, does OPEC wants to supply and having oversupply to the market? I doubt it now, because some major OPEC countries want to maintain the price above 60. Why? Because they want to gain some capital lost during the last 2 years, and they want also not to let the competitors to come to the market again, which is the shale producing companies in America. The cost of the shale oil in America is 55 to 65, say $60 per barrel. So if they let it to be, if they supply more, the price of Brent will go down. If they maintain the sanction over their production, the price will go up and competitors will go in. Now, does OPEC at this time wants to supply more to the market? I doubt it in the coming 1 month or 2 months or even 3 months. And if they want to supply, they will not supply a big quantity. They will start with 1 million, 2 million, maximum of 5 million. This 5 million, yes, will have effect, but 1,500,000 will not have that much of effect. Okay. The other non-OPEC countries like Iran, Iraq, and Libya, they will be supplying oil. However, stability is a factor in these countries, especially Iran. If there is a war, then there will not be production. If there is instability in Iraq, the increase of production will be limited. If there is a stability in Libya, production will be increased still, but it's not going to be a sudden increase in 1 month or 2 months time, because oil business is not in 1 day or 2 days to open the valve and then have the supply there. So the supply, the additional supply coming to the market, it's not going to be big in 1 year, in 1 month, or in 1 month time. Now, do you think that the growth in demand will be with the same ratio of production increase? I think we see in the last 6 months a demand coming from the transportation, reflected on the future contracts for Brent as well as Marban. So I will say that yes, we have an increased demand from the market due to the lifting of sanction on transportation resulted from COVID-19 pandemic, and that's very clear, seen on the number, on the counter number of the rigs. Rigs are being hired and their rates are increased, and that tells us oil companies or producers they want to drill more from new wells or from existing wells to do the maintenance and recover more oil. So the number of rigs utilization is increased. The demand is of refineries is increasing. Now, balancing of these two reasons should affect your decision. Goldman Sachs is predicting for the second quarter the Brent price to be in 80. Morgan Stanley's is predicting it 70. These are analysts who are predicting the oil price in the coming quarter. Are they aware of everything? I'm not sure about that. Let us make our own decision. If we see the graph now of Brent trading on the last 3 months, you will see it varies between the 50 to the 70. 71 was the maximum and 58 was the lowest. Okay, so we are going into the flat range on Brent. No more sharp. We are going into this flat fluctuation in the 3 months. Now we look to the prices for future contracts, and they are fixed for 1 month. They are in the range of 63.3 for Marban, as well as Brent of around 68. So we are actually in the range for the coming 1 month or 2 months or 3 months, in the range of 60 to 70. Now, if we opted to make our average trade in 1 month time 65, any value below the 60 you have to buy to the maximum, get the maximum leverages from your brokerage 600 times, 500 times, or even more. If the price of Brent goes above the 70, you go and short. And from these fluctuations of 2 to 3 or 4% in daily trade, you can make by the end of the month 100% on top of your portfolio. That means if you have $100 million, you can make it $200 million. If you have 1 million, you can have another 1 million. However, if the oil price of Brent goes beyond that 70 and you see a loss of 5%, just close your orders. Now, if we look to the risk analysis of Brent, we can see them on this graph, and you can see that there is 66% of risk of Brent to go beyond this range, and this can be seen on this graph exactly. But the 66% can be 83% risk or no risk to have Brent in this range, because the two reasons that are contributing to the percentage of risk, you can give them only 0.5% weight, because they are not going to be implemented in 1 month time. So this is our analysis, and hopefully you make good profit, and I want to see you making 100% in your portfolio. And thank you very much, and appreciate your listening to our analysis. This is Khalid Al Amri. Thank you very much.